All right, everyone, we are live right now. Thanks for being here, part of the Real Estate Joint Venture Club. We really do appreciate you. We're live right now on Facebook and on Zoom, and I have my special guest here with me today. It's Sam Young. Hey, Sam, how you doing?
Good. How about you? How's everyone doing?
Everyone, everyone, we're anxiously awaiting your arrival, Sam. We're
Can you
very,
hear me?
yeah, really, yeah,
Okay, good. Yeah.
yeah,
Excellent. Yeah. Thank you.
I mean, everyone saw the questions that I came up with. So
Mm-hmm.
I kind of let everybody know how we know each other for the last couple of years. And I've had the privilege of being able to sit down at tables when you are going through private and public company strategies and really consulting. And I said, hey, Sam, do you want to, I've been learning a lot from you. And I remember this one conversation. I was walking out of one of our meetings and I said, Sam, thank you so much for coming and helping me with all of this that I don't understand. And he goes, well, Odin, you're not a professional financial advisor or an accountant, and I wouldn't expect you to know this stuff. He goes, that's what I'm here for, is what Sam said. And in that moment, I realized he should be talking to our group. So then I said, Sam, do you have a presentation? And Sam says, well, he does have a presentation, of course. But he goes, I want to do something kind of for you, especially. He goes, I see you always taking notes. And I'm like, oh no, it's true. I do take lots of notes. And he goes, go through your notes and come up with a ton of questions. And so I said to myself, okay, sure, no problem. And I thought it was going to be a daunting task, but I write physical notes, guys. And here's what my file folders look like. That's just one client. And I went through that big, thick stack of papers and I came up with over 40 questions. And then the last number of weeks, I've been kind of asking these questions with individuals, and we came up with some questions that we're going to answer today, and then some we're just going to kind of leave hanging.
Yeah.
And then the intention is this, guys. I'm going to get together with Sam afterwards, and we're going to answer each question together between 30 minutes and 2 minutes, and then we'll provide all those answers to you on the JV Club. So it's going to be really awesome. I'm really looking forward to that, having all these questions answered. But for today, what we wanted to do is we wanted to go through an overview of the most important questions that we were able to come up with. And you guys can interact with us, ask questions. We really want that interaction in some way. I wanted to put this a disclaimer here as well, basically saying that anything that we say, please go and check it out with other professionals. What we say today may change tomorrow and so on and so forth. And I just want to make sure that you guys understand that we're giving you what we understand to be the best information possible today for you and your business, but always double check everything is my suggestion. That's from me, and that's coming from me. And I wanted to share, this is, by the way, you see Sam live there as well, but I wanted to show how impressive Sam is. He's been affiliated with a lot of companies for many years. And he's got the experience that I know we need when it comes to answering the questions that we've proposed in front of us here. So you guys can take a look at that. And there's a way for you to get a hold of Sam later on. I'll share that information because you're probably going to want to reach out and talk to him. He will be able to help you. He's certainly helped me. So what I've done for today in today's presentation is I've got about 5 to 8 questions over 22 slides. And what we're going to do is that we're going to kind of go through the first couple of questions that I've highlighted. And what Sam's going to do is he's going to talk about that from his perspective and profession. And then we can add any questions and we can kind of maybe draw it out a little bit. He's got about 30 minutes to 45 minutes for this process. And he is more than willing to come back if we all say this has been awesome. So Sam, the first question I have is what are the different forms of business organizations?
Okay, thank you, Odin. Yeah, so good evening, everyone. So it's my pleasure to be here today. And first, I want to just, I don't know whether Odin give you some introduction of my background. I'm a CPA and a chartered professional accountant, and CFA, chartered financial analyst. So I've been involved with private company, public companies for many, many years, almost like 25 years. And I was working in a Securities Commission before. So I'm very familiar with going public process. And also,
Sam, weren't you part you say you were part of the Securities Commission. Can you tell me a bit about that? That's interesting.
Yeah, like Securities Commission is basically the government agency to oversee and regulate the security industry. Like if people want to go public, for example, they file an IPO prospectus. So the commission would be the one that reviewing and vetting the prospectus and make sure there are full, true, and plain disclosure about the companies, the management, the investment, the securities, and the business financial statements. So we review all those information, make sure that it provides a full, true, and plain disclosure to the public. Okay? So yeah.
How many of those did you go through in your time there, out of curiosity?
Oh yeah, lots, plenty. So because like I was working there for almost 6.5 years. So I work at the commissions in the corporate finance department, also in the enforcement section. So enforcement section is like they would review if there's any irregular activities in the security industry. Right? So that's the enforcement section. I was there for 1.5 years. So I work in different sections in the Securities Commission. It's a very like interesting, high-profile department because like anytime you go public, you have to go through that Securities Commission reviewing process. Eh? And if you have any violation of the law, I mean, you could be penalized by the Securities Commission. So you have to follow the rule of the Securities Commission quite it's very, very difficult, and you have to follow the rules and regulations strictly. Eh? Otherwise, if you fall outside of that legislation, then you'll be penalized.
And does that have to do with the trust element that the Securities Commission wants to have everyone going in with? Is it a trust element?
Oh yeah, that's always a trust element. But one of the mandate of the Securities Commission is to protect the public interest. Basically, that's the mandate of the commission, is to protect the public interest. That means they don't want people to just raise money for their own interest, okay, for their own good, not for the shareholders, for the benefit of the shareholder, because when you're investing in a company, obviously you want to benefit from the investment, right? So, and then they don't want, that's why I think they check the background of the directors and management of the public company. Like every time you want to apply to become a public, they do a background check on you, like criminal background check, financial background check, everything. They check, your history. Mm-hmm. And if you're outside of Canada, you like immigrated from outside, we check the Interpol, like international police record and everything. Right? So
it's a very rigorous process.
Oh yeah, it's a very rigorous process in order to be listed on the stock exchange in Canada. Right? So, anywhere in the world, basically, right? In the States, the same thing, right?
So the capacity that we've been working together is that we're working on a non-registered reporting issuer, which is a company that's just in the process of going public. It's just that if they're pre-approved to go public. Now, getting back to the question here, what are the pros and cons of public versus a private company? I know that there are.
Yeah. So maybe I go back to your first question about 3 different forms of business organization first, right?
Sure.
So that's the first question you listed on the screen. So there are basically 3 forms of business organization in general in Canada. The first one is proprietorship. A lot of you probably know that already. Proprietorship is like an individual. You can operate a business yourself. So in Canada, it's very, very simple. You can set up a business yourself. Okay, just like for yourself, Odin, you can probably say, hey, I want to do operate a business under my own name. Okay, you can even register a trade name. So you can say ABC, let's say trading. That could be one of your trade name. You can register a trade name, but it's the legal ownership is really yourself. You are the legal owner, right? You individual legal owner. So that's one form of business organization. Very, very simple. Proprietorship. Like you just operate the business yourself individually, right? Personally, basically. So you just file one tax return, like your T1, your regular personal income tax return. You don't have to do another separate tax return. So it's a very, very simple form of business organization. So that's the kind of the basic, one of the most basic business form of organization. Right? And the second one is a partnership. So instead of one individual, now you have 2 individuals to form a partnership, right? And or you can have limited partnership. or joint venture, so those are more than one individual, basically that's what is called partnership, right? Now, partnership itself is not really a legal entity. So legally speaking, partnership is not filing a tax return, okay? It's the partners, each partner. The partner could be corporation, could be individual. They file a tax, okay? And you have a limited partnership, which is very common in the real estate business. Like you form a limited partnership to raise some money, and then you do the project, especially for development project. A lot of joint venture is really limited partnership structure.
Mm-hmm.
Okay, and then you would do that as a limited partnership, because the benefit of doing that is you have limited liability. Each partner, LP, unit, or holder would have limited liability. The liability is up to the amount of you invested in the limited partnership, right?
Okay.
So that's another form of business organization, which is a little bit more complicated than proprietorship, of course, because you're involving partners, right? And then you have to have partnership agreement to make sure the terms and conditions of the partnership is set out clearly, among the partners. Otherwise, you have dispute, arguments, and how you're going to settle that is based on the agreement, right? If you don't have any agreement in place, you'll be in trouble.
There's a takeaway, everyone. You got to make sure you have agreements in place beforehand.
Yeah, like a limited partnership agreement and everything. And in a limited partnership, you have a general partner normally, right? Because the general partner is the one taking all the liability. Basically, that's what it is. Okay. And the last form of business organization, which is the most common one, like most people know, is limited company, like corporation, right? So that one is most business operate as a corporation because you have limited liability. Okay, you don't want to have liability beyond what you invested in the company, in the business, right? So that's the most common form of business organization is really corporation. And so that's the first question that you asked is 3 different forms of business organization. And then among the companies, you have basically, we can classify into 2 types of company. One is called private companies, and then the other type is called public companies, right? So what are the differences? Private company basically is owned by individuals that like a small number shareholder. Okay, so normally it's less than 50 shareholder. Okay, once you're more than 50 shareholder, you're almost like a public company. Okay, because the requirement, like when you incorporate company, you normally would not have more than 50 shareholder, because once you have more than 50 shareholder, they treat you almost like a public company. Because a public company, in a public company, you could have a public company that are listed and may not be listed. Okay, so at the example you use is that we have a basically non-listed reporting issuer. Reporting issuer is in other words kind of like similar to a public company. Reporting issuer means they have to report the financial statement to the Securities Commission. That's what reporting issuer. The definition of reporting issuer is they must submit their financial statement to the commission, to the Securities Commission, through SEDAR. SEDAR is a disclosure kind of financial statement system that you can review all the public company financial statement online, right? So you can go into SEDAR to find any public company's financial statement, information circular, the annual, the annual return and the annual report, those kind of documents.
Does that make it a more trusted company when it's being?
Yeah, because when you have the exposure to the public, you have to basically you have to make sure your company financial statements are audited. Okay, so first of all, it must be audited annual financial statement. The quarterly financial statement is not audited. Okay, so first of all, you have to have updated quarterly financial statement. Private company, you don't have to, right? You just file one annual financial statement.
Do they have their stuff on SEDAR as well, the private company?
Private company won't, right? So they don't have to, right? The private company, basically, you don't want to show your financial statement to anybody except, maybe your banker. Like basically, you don't want to even show your financial statement to anybody else, right? Basically, right? Because it's a private company financial statement. You keep everything private and confidential, right? Whereas public company is the opposite, because when you're a public company, your financial statement are subject to review by the commission, by stock exchange, by the general public. And if you have a bigger company, then will be by a lot of financial publication. They will review your financial statement and see if there are any, because there will be a lot of analysts following your company's performance, right? So.
Cool. So for the other questions here, guys, those are going to be the 30 minutes to 2-minute answers that we'll get from Sam. The other 2 questions I have on the next page, you guys can read these questions. They're all going to be answered. But what I have right here is the next ones is what are the different ways to go public, and what is an IPO or initial public offer?
Yeah. So in summary, there are 3 ways you can go public. The first one is very, very popular. Everybody heard about the IPO, initial public offering. An initial public offering is basically you file a prospectus, which I mentioned to you before, is a disclosure documents, basically contain a full, true, and plain disclosure about the company, the management, the securities you offer, the use of proceeds, what you're going to use the money for, the financial statement, financial performance of the company in the past 3 years, and any project that you have in mind, your description of business, your directors, your management. Basically it could be a few hundred pages long. The IPO prospectus could be very, very long, and the process could be years, like at least 6 months to maybe a year, because you have to find a sponsor. A sponsor is a broker that sponsor you to get listing on the stock exchange, and then you have to find an underwriter agent, to sell your stock to the public. So it's a very lengthy process, and people are reviewing your company's financial statement, agreements. They do due diligence, on your company's operation management. You're under scrutiny, basically, right? So it's a very strict, and stringent, process that you have to go through, and it costs a lot of money. IPO costs a lot of money. Yeah.
But there's obviously a benefit to it, or people wouldn't want to.
Yeah, the benefit is you raise money, right? You raise money, and normally when you the difference is this: like when you have a private company, a public company, right? Private company, the valuation of a private company is much, much lower. Okay. So if you look at like a similar type of business, and they make the similar kind of money, EBITDA, basically your earning before income tax, depreciation, and the interest.
What was that again? You repeat what the abbreviation of that, what again was?
Yeah, earning before.
No, the abbreviation.
EBITDA, EBITDA. Yeah, basically earning before interest, tax, depreciation, and amortization. Okay. So what happened is, so let's say you have, $1 million EBITDA, okay, in a private company. Normally, the value, the fair market value of your company share is about 3 times of that, like 3 million, let's say, okay. But when you go public, your value could be 10 times to even 20 times, depending on the types of industry you're in. And so the valuation is much, much higher, in a public company sector compared to a private company, right? Because in a private company, the reason why the valuation is much lower is because there's no market for selling your market, like private company share, right? Whereas in a public company, there's a market is readily available for you to buy and sell your stocks, right? So when you look at the advantage of public companies is the share that you own, you can buy and sell easily on the market, like stock exchange market, right?
So shares are at this point, when you buy into so is it wise to buy into a company before it goes IPO? that's on its way?
Oh yeah, definitely, because like that's why a lot of venture capital company, they do that, right? You know, like when IPO, right? So Tesla, you know, if you buy it when they were private company, Facebook, when you get it a private company, of course, the valuation much lower. So a lot of venture capital, they do that. VC, right? VC, they find some unicorn, you know, like, hey, this is what I want to put money in, you know, like they expecting like not 10 times, 50 times, 100 times, you know, like.
Can I just share something really quickly?
Yeah, yeah.
I used to work with a company that does IPOs, so I'm familiar with what you're talking about. But I have a friend who 7 years ago, and you know who he is, Odin, that they took the company on to NASDAQ, and their shares started at 70 cents IPO, like initial public offering. They are now over $60 in 5 years. So
Yeah, that's why I'm saying that's the benefit.
Yeah.
Of going public, of course, right? You know, like, and that's what VC looking for, right? Of course, like when VC investing in those unicorn or whatever high risk investment.
Yeah, definitely.
Yeah, it's not like every time they make money. That's why they look for big return, you know, because a lot of time they invested into those, you know, new tech, high tech company, newly established. They burn a lot of money, cash, right? So not everyone is successful. That's what happened, right? And as Cheryl was saying, exactly like one of the company a lot of you can look at is like BokBok is a very good example. I use BokBok a lot. When I talk to Odin, is like for real estate company. BokBok, when they went public, it was only, I think, 6 cents. You know, now it's about like 20, $30, right? So
yeah.
So that's what. So if, of course, when you get into the initial stage of a company before going public, you can make a lot of money, but that's no guarantee, right? I mean, nobody can guarantee that. Hey, you invested into this company 10 cents and then going up to.
But now we're talking about investing in people, right?
Yeah.
Now we're talking
exactly. Like I mean, it's okay. What I want to say is like it depends on a lot of factors, right? You have the economic condition. You have to look at the people, the management. But even if you have very capable management, but the economic conditions not doing well and the opportunity just not really like what you are looking for and not materialize, you know, there's no guarantee. But that's what the risk you're taking, right? Of course, you know, every time you make an investment, it's a risk you're taking, right? So the higher the risk, the higher the return. You know, like I mean, that's always the case. That's the but of course, there's a chance you lose money too, right? Nobody can guarantee you're going to make money for sure, right? So, but that's what happened is the IPO process is like Cheryl was saying, you could make big bucks, but nobody can guarantee that you could miss the boat, you know. And the other way that you can go public is reverse takeover, which is very common, like RTO. We call it RTO, is that you buy a shell company and then it's a cheaper way to do it. It's not as lengthy because normally you have a lot of, you know, like
we got a question. So we got a question from Joe about going public. Joe, first of all, thank you for putting EBITDA up on our chat. I appreciate that. But what would the cost be for going public for a real estate company? Just an estimate is what Joe.
Well, it depends on how much you raise, right? So generally speaking, just the professional fees alone. I'm not talking about just a commission, because when you go public IPO, you have to hire a broker to sell your stocks, right? Those are commission. The commission could be 10%. Okay, it could be as high as 10%. But just to talk about the professional fee, like legal fee, auditing fees, corporate finance fees, and yeah, not counting the brokerage fee, you're looking at $200,000-$300,000 minimum. Okay, like if you go full-blown IPO, okay, and that's why reverse takeover is a little bit cheaper, because reverse takeover, you have a shell company readily available, and that save you a lot of time and cost, eh? But when you do the reverse takeover, normally what happens is you don't raise a lot of money. You do some private placement, you don't do IPO because you're not preparing a prospectus, right? Because prospectus, the use of prospectus to raise money, okay, at the same time, right? When you go public, you raise money at the same time. But when you do RTO, normally you don't raise a lot of money. You may do some private placement at the same time, raise maybe $1 to $2 million kind of private placement, and the good thing about RTO is as I said before, it's cheaper and also less time consuming. So you could cut the time to at least half, maybe even more, depending on how complicated is the deal, right? So we did a lot of RTO before. Normally it takes about maybe 3 to 6 months to complete the whole process, right?
Mm-hmm.
Yeah. So
with reverse takeover, the company is already public and trading on the exchange.
Yeah. So when you do RTO, it's a shell company that is a public company or already ready to become a public company, like a reporting issuer, but it's not listed, non-listed reporting issuer. Okay, that's a shell company ready to go public. The reason why it's available is they have enough shareholder, because you have to find at least 150 to 200 shareholders, right? When you have a public company, to find a shareholder takes time, right? But if you have a company that's already have this kind of shareholder, this number of shareholders, if you reduce the time, you have to.
Hence, harder to raise as much money as an IPO.
Oh, definitely, yeah, because the reverse takeover RTO is not for you to raise money, basically. It's that for you to go public first, and then you raise money afterward. You raise a little bit of money, as I said, $1 or $2 million at the beginning, like through a high placement, right? But reverse takeover is not for you to raise money. It's really like at the same time. You could raise money later on. At the beginning, normally what you do, you have some seed capital at a very low price. Because you use the seed capital for paying all the fees, right? And then you raise about $1 to $2 million to do some projects, okay? A private placement. So you'll be maybe a little bit higher price. And then you roll the properties or asset into the PubCo, and then get listing. Once it get listing, then the share trading, and hopefully the price going up. So then you raise more money, because you don't want to have too much dilution, right? To dilute your ownership, right? That's the reason why you can't do it on a stage by basis. So you do the stage one, which is seed capital, raise sufficient money to pay the fee, but at the lowest.
Reverse takeovers are not exciting for public investors. So reverse takeovers use a lot more private placement cash versus public.
Exactly. Yeah, exactly. Because what happened is RTO is what you're trying to do is you want to, it's almost like a VC, a venture capital process. You kind of doing it like a VC venture capital. You raise a little bit of money just at the lowest price possible for the hope that the price is going to go up, and then you raise more money, because at that time you have less dilution, right? Because so let's say at the beginning you may raise it at 10 cents, and maybe gradually increase to 50 cents, and once the company is doing well, like the operating result is showing a very positive and profitable trend, then you could, the market price could go to like $1. Then at that time you say, hey, I want to raise more money, because then less number of shares to be issued, right? For the same amount of money that you're going to raise, right? So that's why you do RTO route, instead of IPO. But the IPO is good for when you have business that like a very exciting right at the beginning, right? So like Facebook, those kind of exciting business that your valuation is very, very high already, right? So
so what I'd like to do is I'd like to kind of move on to the next question. We'll answer the other one about CPC at other time. I want to be cognizant of time. We have lots of questions that I want to ask. Why go public? What's exactly is the difference between public and private companies? when I first, and I want to just say to everyone here, guys, it's been a learning curve for me too. So if this stuff to you right now is like, oh my gosh, what in the world is this about? That's how I felt at the beginning. And Sam can attest to that because he's been watching my growth, and it's pretty cool. So we're asking you guys to grow with us. So this is not some one-time presentation. This is going to be an ongoing, and you guys are going to see me grow with this process. So I wanted to understand, what is the difference between a private company and a public company? Because when we were talking to individuals, very often they confuse the two. And so what are the differences? They really do look the same. I mean, you've discussed a lot of it already.
Yeah, I think what happened is a private company, well, as I said before, private company are owned by private individual, and normally it's a small group of investors. It could be family, right? You know, family, friends, you know, they get together, form a company, and and they want to invest in some business of a joint venture or real estate business or real properties, buy a few rental properties, and they want to keep it private. And that's the advantage of being a private company is you don't have to disclose financial information to anybody, and in terms of expenses, you don't have to worry about like how you're going to write off expenses and everything. Nobody's going to question you because you're a private company, right? Except CRA may say, hey, what is this? What's this? That's it, right? You don't have to report to anybody, basically, right? But the disadvantage of that is all the investment or capital that you put in is all your money or your friends or relatives' money, right? So a little bit limited in terms of like financing alternatives, right? When you have a public company, that's a little bit different, because when you're a public company, then you can raise money through the public market, right? The stock exchange, and also the other thing is, like, even when you're seeking investment from other investors, like beside your close friends and relatives, people may find it a little bit more trustworthy because you're a public company. Your financial statement are audited, and your quarterly financial statement are all must be filed every quarter. You cannot be late, because once it's late, then stock exchange will cease trade you. You cannot trade anymore, right? So you're basically all your financial information would be readily available for anybody to look at, right? Whereas in a private company, so if somebody beside your friends, close friends, and your relatives, if you want asking people to invest in a private company, they may say, hey, okay, what do I get at the end? You know, financial statement, anything like that? You know, okay, you can prepare financial statement, but it may not be audited because you're not required to be audited, right? And also you don't need to prepare quarterly financial statement either, right? So you don't have to keep them quarterly report.
It's a lot more lax, it sounds like to me.
Oh, for sure, yeah. Being a public company, you have no choice. You are required to do that. Like, you have to provide quarterly financial statement. You have to provide audited annual financial statement, right? And every quarter, you have to do a management discussion paper. You know, discuss the MD&A. We call it MD&A. You know, analyze the performance, the management performance, and everything. And so it's really more exposure. You know, like transparent for sure in a public company, right? And that's why the investor could trust the system, you know, to invest into.
One of the things, right? Yeah. One of the things I heard is that in a private company, a director can pretty much get with do whatever they want, but in a public company, a director cannot get away with pretty much whatever they want.
Oh yeah, because of course, like, you know, in a private company, nobody is overseeing basically the management, right? You know, when you are in a public company, you have a lot more regulators looking over your shoulder, right? So, and not only that, because every year you have AGM, right? Annual general meeting, and people can vote you in and out of a board of directors, right? So you have to perform, right? In a private company, there's nobody, you know, really doing anything. If you are the president, and all your investors have friends and relatives, right? You know, so unless you get into trouble with them, right? They don't like you, and then it's a little bit different, right? So I think there's, as I said, there's pros and cons of each alternative. Like private company, there's pros and cons, and a public company has advantage and disadvantage as well, right? So people just have to weigh in and which one is better for them, you know, like to decide, do you want to stay private or you want to become public, right? So I think like as I said before, two very good examples that for public company in the real property, real estate business is like a Main Street is one good example, and the other one is Boardwalk, and they all started with like I think 10 cents share, and now I think in Boardwalk it's about $30, and Main Street is about $60. So those are very good example. Like I was talking to Olden, I say, hey, that's the model you have to follow if you want to grow the business to become a successful public companies in the real estate business. And I
guess what, guys? I'm listening to him.
Yeah, and I think one of the characteristics of those companies that you can I think they have common in nature is I was talking to Olden about that, is you have to have cash flow. Those are all cash flow properties. Like you look at Boardwalk, you look at Main Street, they produce income, and in a public company, that's what they're looking for. Why do you want to go public? That's one of the questions that people ask, like, why do you want to go public? You have to grow, because when you're investing in a public company, you're investing for the future growth of the public company. It's not investing in what they have done, because what they have done already is reflected in the price. So whatever you pay, you already like, that's reflecting what happened in the past. But what you're looking for is, hey, it's going to go up, right? Like, so what you pay is you pay the price, let's say $50 share now, that's reflected what happened in the past, the financial performance, what happened in the past, right? But when you pay that $50, you're not just hoping, hey, what happened in the past. We're looking for the future, right? So and so when you're hoping the price will go up, right? The only way it will go up, as I said before, the $50 is already reflecting what happened in the past, the past performance, right? The only way the $50 will go up is the company will do well in the future growth, right? To $60, $70. And how do you do that? You must grow to get that to 50, 60, $70, right? If you don't, it will stay at $50 or even lower, right? Because the price is reflecting what happened in the past, right? The past performance, right? Well, so that's why.
I kind of wanted to touch on how Boardwalk and Main Street and what their model is a little bit, because you've mentioned it. What they do is they use a Section 85 rollover. So they identify companies or individuals that are going to have huge tax burdens because of selling. And what they essentially do is they go to them and they say, hey, we know you're going to have a tax burden. How about we do a Section 85 rollover? And then before you answer that, Valor had one question, which is real estate public company versus REIT. What is the difference? So let's maybe answer that question and then talk about Section 85. Or you could, whatever way you.
Well, I'm going to, you have that question, Section 85 rollover here. Like, so Olden raised a very good point. Like, under the income tax act in Canada, you do have a Section 85 that you can defer income taxes. So let's say you have a real property, you have a rental property, 100-unit rent apartment building, and you want to sell. So you could sell so the model of Boardwalk Main Street is, hey, owner, like a rental property owner, I can do a deal with you, okay? Your building is worth $5 million, and your tax cost means, like the cost that the cost base that you don't have to pay tax, okay? So your tax cost is the base. So let's say your tax cost is $1 million. So what happened is they can go to the building owner and say, hey, we're going to pay you cash of $1 million, okay? The balance, the difference between the fair market value and the tax cost of $4 million, we can give you some shares of Boardwalk, for example, right? Or one of the PubCo. And then, and the reason why they do that is, hey, the $4 million that you get shared instead of cash is tax deferred. You don't have to pay tax immediately, okay? The only time that you have to pay tax is when you sell the shares, right? So let's say when they do the deal, the Boardwalk will give them shares equal to $4 million at, let's say, $1 per share. Just using that as an example, get 4 million shares, right? So at that time, at the time that they complete the deal, when they do the Section 85 rollover, there's no tax payable for the building owner. Okay. Now, let's say in the future, 1 year later, the share is now worth $2. So he said, I want to sell some share, right? He's going to sell some share. So he say, let's say I want to sell 100,000 shares. So the 100,000 share, he would have to pay tax on that. But that 100,000 shares now worth $200,000 now, right? Instead of $100,000, right?
It's worth $2 a share is what you're saying.
Well, because it was dollar share before, right? Now it's $2, right? So it's 200,000. So he would have to pay tax on the $200,000 because the cost base for that 100,000 share is basically zero. Right?
We have some tax stuff right here, actually. I just want to share this with everyone here. Sam provided this to me. So what you're essentially saying is that they will end up saving quite a bit of money.
Well, at the beginning, they would save a lot of money because they don't have to pay tax immediately, right? But when they sell the share, of course, they have to sell it to realize a capital gain. But the good thing about capital gain is half is taxable, right? Half is not taxable. So let's say the $200,000 that he make, right? He sold a share and then he realized a capital gain of $200,000, right? So only $100,000 are subject to tax because the other 50%, 100,000 is not taxable. It's not taxable, right? So he only paid tax on the $100,000, and then he would have to pay tax according to the tax bracket, which I showed in here. Depending on which tax bracket he's at, right? So if that's the only income he has, he would gradually pay. Like, I mean, in Canada, the tax rate is progressive. That means the high income, the high tax rate, right? So that's why, it doesn't mean that he's going to pay tax at like 30-something% when it's over $100,000. No, it's just gradually, right? So the first 41,000 you will pay like 20% and so on and so forth. Like this is the kind of table that you are subject to this tax bracket in BC in year 2020. Right? So and then depending on different types of income is the different rates.
So one of the things that I learned from you over the last little while talking about the Section 85 rollover was that if you do it in a private company and you sell that in a private company, those taxes are due right away. There is no tax deferral.
If you don't do a Section 85, then it's no deferral. But you can do it in a private company too, like the same thing.
Okay, cool.
Private company, you can do that too, like Section 85 rollover. It doesn't matter what kind of company, as long as you're a Canadian corporation, you can do it.
The only difference though is you're not going to get that share increase.
Exactly, you may not get the share increase because when you're doing with a public company, then the share price may go up. Right? In a private company, normally like it's no market, right? So nobody can say, can tell, right? Yeah. So
let's just say I didn't do a Section 85 rollover and I had this $5 million property, and then I get my $1 million back, and then I'm essentially going to pay $2 million right away to the government.
No, what happened is not 2 million. No. What happened is like, let's say, in the same example, because 2 million is not taxable, 2 million is taxable. So when $2 million, then you subject to tax.
Okay. So is it better?
So subject to tax based on like your tax bracket, right? Your income tax rate of tax bracket.
Okay, I understand. It's a specific question to your specific situation. I get that. So is it wiser for an individual to do a Section 85 rollover into a public company versus a private company?
It doesn't really, I wouldn't say that it's wiser or not, but it's just like depending on, first of all, Section 85 rollover is not for everyone. Okay? Because some people may say, no, I don't want share, I don't want cash. I don't care, like I pay tax, fine. I get the cash and I pay the tax, right? So not for everyone, because when you do shares, there's a lot of reason why people do Section 85 rollover. So private companies do, a lot of people do Section 85 rollover because they want to defer tax, right? And in a private company situation, you normally control your own destiny. Basically you control the property anyway, right? So to them, it doesn't really matter. It's just they just want to defer tax and send it in, like set up the property in a private company. And maybe it could be a piece of land they want to develop. and they roll into a private company at like a fair market value, but using Section 85 rollover, because it doesn't make sense for them to pay tax now because they haven't realized any cash, right? They wanted to develop this piece of land, and the reason why they want to set up in a company because they want limited liability, right? So for a project, it's not really for income tax purpose. In that
That's
case.
kind of what we're doing too, isn't it?
Yeah. So basically, for sure, because when you do development, there are a lot of liabilities, right? You know, like construction, you know, and so on, you know, and it takes a long time, right? Development project, right? So that's the one of the reasons why people still want to do Section 85 rollover, right? Because they're not realizing cash immediately. What they do is they want to roll into companies so that so they could have let's say a holding company, they hold a lot of assets, and they don't want to use that company to do development because it doesn't make sense, right? Because anything happened to that project, all your asset will be subject to risk, right? Subject to claim by creditors, right? So normally you would roll into a company, separate company, for development project because you want to protect your other asset, right? You know, like against like from any credit.
So then, does that mean that when the project is done from the private company, we've rolled it in Section 85, we've got we've done all the thing, now the public company is ready to kind of roll that in? Is that kind of how it would happen?
It could, yeah, you could do it that way too if that's what you want to do, a public company, right? But some people may say, no, I don't want to do public company is fine too, right? In fact, like I said before, a lot of development project is not in a public company because public company cannot wait for long time horizon, right? Because a development project could take years, 5 years, 10 years could be, because just to get a development permit, building permit could be like in Vancouver, you could take 5 years, 10 years. I heard some story, like a terrible story, right? Like a long time. I have some clients, they waiting for development permits around Vancouver area for a long time. Right? So when you do development project normally, you don't put it into a public company right away because it's just like it's too time consuming. You normally do a private company or do an LP, raise money in LP, develop a project. And then later on, you want to roll into a public company, you can do it, or you just sell off, make some money, distribute the cash, done. You know what I mean? That's what a lot of development projects are doing. And so you look at most of the developer in Canada, most of them are private companies, not too many public companies. Most of them, like Concorde Pacific, used to be a public company. They privatize it because they know it takes too long. They hold the land for so long. The market share price is not reflecting the true value of the company. So then they say, why keep public, right? So that's why they privatize. Like Concorde Pacific used to be a public company, but they go private because they say, hey, we have a whole bunch of land worth a lot more money than the book value, but it's not reflecting on the market price, the market price, the share of the company. Then they just say, hey, to heck with it, you know, the owner just privatize it. They just pay out all the shareholder and then say, I privatize, I make more money. You make more money that way, right? So
I just have a question.
Yeah.
How does a land trust come into play on this then? Like, is there ways to like shelter the money through a land trust, or is that something totally different?
Well, land trust is a little bit different. Like when you're talking about when you say land trust, does that mean you're like a declaration of trust kind of situation?
Well, example, like you could hold real estate in a land trust, right?
Yeah, no. What happened is this, like in BC, there's a lot of companies, they use a bear trustee company to hold the land. The reason why you do that is because you avoid a transfer tax, right? So that transfer tax is a big thing. So you just have a company own the land, lumber company own the land. The legal title belong to the lumber company, but the beneficial ownership could be anybody. So you can sell the beneficiary to anybody, and
you don't pay the land transfer tax. It's a way to.
It's just a way to avoid the land transfer tax, basically. You know, the bear trustee. You know, I've seen it a lot.
Okay.
But what happened now is there may be. I think there's changes coming up because since October, the BC government has implementing disclosure about beneficial ownership. So so if let's say a company, you have a beneficial owner, is not the legal owner of the company, but now you're required to disclose it to the public, to the corporate registry office, and that applies to the land ownership. Now we don't know. I talked to some lawyer; they don't know how tough they're going to implement and enforce these kind of law. We don't know yet, because I think people still using the bad trustee quite a bit. But it's a little bit different. The bad trustee is because in BC you have transfer tax, and it could be very high and very expensive. If the piece of land is like 10 mil, 20 mil, it's a lot of money. So you try to save basically transfer tax. That's what it is. Alberta, there's no transfer tax, and we don't care. That's in Alberta, so we just transfer land title all the time. So it doesn't cost anything. It only costs a couple $100. That's it. To do a land ownership transfer, but in BC it's very expensive. The transfer.
It's great to do that in Alberta, because once you have the land transfer in your name, you can go refinance.
Yeah.
Very nice.
Yeah, so anyway, I think I probably have too much information for you guys. Probably overwhelm you guys. So probably I should maybe stop.
I can't even believe actually the time went by so fast, and we have so many questions.
So already like 8 o'clock. So I think I
know.
Just stop right here, and then
insane.
And then, yeah,
it's awesome.
So
I loved it.
Yeah. Okay, great. Thank you very much. Okay, good luck to everyone. Okay.
Wait, don't go yet, Sam.
Nope.
I still have 4 more minutes. I'm just teasing you. Hey guys, you can see that there was a lot of questions that we had here that Sam wasn't able to go through. We really just touched on it. So I'm going to be pulling Sam on the side over the next number of weeks, and I'm going to be getting these questions answered from him. And then I'll be putting it on a place where you guys can go and you can check it out and get those answers to each of them. At the same time, though, beforehand, you probably have some questions of your own. So please reach out to Sam. He gave me permission to give his information out to you, so he'll be able to communicate with you and ask any questions that you may have. He's part of RSM, and I just thank you so much, Sam. I really appreciate you a lot.
Okay, great. Thank you very much. Okay.
Thank you, Sam.
Okay.
It was great information.
Yeah, thank you. Yeah, thank you.
Bye.
Bye.